Good afternoon, everyone. Welcome to the Bank of England's Inflation Report press conference. On my far right is Ben Broadbent, Deputy Governor for Monetary Policy. On my left is Minouche Shafik. She's Deputy Governor for Markets and Banking. And on my immediate right is Governor Mark Carney.
Thank you very much, Jenny. Good afternoon, everyone. Start with a bit of perspective on the economy. After the worst financial crisis since the Great Depression, the UK's expansion finally took hold about 3 years ago. It was initially driven by sharp declines in economic uncertainty and significant improvements in credit conditions. These helped restore confidence and unleash pent-up household demand. The nascent recovery was reinforced by a more resilient banking system and accommodative monetary policy, with the MPC's forward guidance reassuring households and businesses the bank rate wasn't going to rise at the first signs of growth, and that helped create confidence to spend higher and invest. And that recovery was also supported by a large positive supply shock, particularly a notable increase in labour force participation. At over 3 percentage points annualized, the UK was the fastest growing economy in the G7, despite ongoing fiscal consolidation and persistent global weakness. The growth of our trading partners was running at only about 2/3 of their pre-crisis average. With time, the boost from lower uncertainty faded, pent-up demand was largely spent, and consumption growth became increasingly supported by greater hours worked, a sharp pickup in real wages, although that was largely due to falls in commodity prices, and lower savings rates. Business investment rose with demand and continued improvement in financial conditions. However, trade and fiscal policy continued to drag. By early last year, growth had begun to slow to around 2.5%. As the labour supply shock had largely run its course, and supply growth became more reliant on modest and somewhat erratic growth in productivity. By the second half of last year, though we were still near the top of the G7, growth had moderated to around 2%, or about its current rate of potential supply growth. Turning to the outlook, in the first quarter of this year, growth slowed further to around 1.5 percentage points annualized, and it now appears to be decelerating again. The most recent weakness reflects in part the forthcoming referendum on the UK's membership of the European Union, which has pushed up uncertainty measures to levels not seen since the euro crisis. The referendum makes describing the outlook for inflation more challenging than usual. That's because some asset prices used to condition the committee's projections are likely to have been affected by market participants' perceptions of its consequences. The MPC estimates that referendum effects could account for around half of the 9% fall in the sterling exchange rate since its November 2015 peak, and we've decided not to let that part of the exchange rate's fall feed through to our growth and inflation projections. This judgment is consistent with the MPC's long-established convention to assume that government policy is followed. Specifically, we've conditioned our projection on an assumed continuation of EU membership, and as a consequence, the forecast also assumes that the current elevated levels of uncertainty unwind in the months that follow the referendum. In the committee's central case, the outlook for inflation is in most respects similar to the one we described 3 months ago. The MPC continues to expect CPI inflation to pick up over the next year as the impact of past falls in commodity prices fades and as the effects of the earlier appreciation of sterling wanes. The recovery in inflation is likely to be further supported by the recent sharp increase in oil prices and some additional stimulus from lower market interest rates. Moreover, if demand evolves as expected, the remaining spare capacity in the economy will likely be used up during 2016, in turn raising domestic costs. The committee judges it likely that these factors will be sufficient to return inflation back to 2% by mid-2018 and push it a little above target thereafter, reflecting modest excess demand. Now, the central projections sent out in the inflation report today are conditioned on a gentle rise in interest rates over the forecast period. And under that central case, the MPC judges it more likely than not that bank rate will need to be higher at the end of the period than at present in order to return inflation to target in a sustainable manner. Our now familiar forward guidance on limited and gradual rate increases and conditions for asset sales continues to hold. Now turning to the elephant in the room. The MPC judges that the most significant risks to its forecast concern the referendum. With macroeconomic and financial indicators likely to be less informative than usual in light of the referendum, the committee is currently reacting more cautiously to data releases than would normally be the case. There is a risk we could be over or underestimating underlying momentum in the economy in the event of a vote to remain in the EU. More profoundly, a vote to leave the European Union could have material economic effects on the exchange rate, on demand, and on the economy's supply potential, effects that could affect the appropriate setting of monetary policy. The recent behavior of the foreign exchange market suggests that were the UK to vote to leave the EU, sterling's exchange rate would fall further, perhaps sharply. This would likely be consistent with changes to some of the real fundamentals that drive sterling, including the terms of trade, productivity, and risk premia. In isolation, a further fall in sterling would boost inflation over the policy horizon. Aggregate demand would also likely fall relative to our forecast in the face of tighter financial conditions, lower asset prices, and greater uncertainty about the UK's trading relationships. Households could defer consumption and firms delay investment. Global financial conditions could also tighten, generating potential negative spillovers to foreign activity that in turn could dampen demand for UK exports. All else equal, lower aggregate demand would tend to reduce inflation over the policy horizon. However, over time, there may also be negative effects on aggregate supply, including slower capital accumulation and the need to reallocate resources across the economy in response to changing trading and investment patterns. On their own, such supply effects would tend to boost inflation over the policy horizon. So this combination of influences on demand, supply, and the exchange rate could lead to a materially lower path for growth and a notably higher path for inflation than in the central projections set out in today's inflation report. In such circumstances, the MPC would face a challenging trade-off between stabilizing inflation on the one hand and stabilizing output and employment on the other. The implications for monetary policy would not be automatic. Its direction would depend on the relative magnitudes of the demand, supply, and exchange rate effects. Now, whatever outlook materializes, the MPC will determine the course for monetary policy that delivers the inflation target in a sustainable and timely manner, which generally means returning inflation to target within 2 to 3 years and keeping it there. So to conclude, the people of the United Kingdom will make a significant decision on the 23rd of June, and they will do so after considering a much broader range of issues than monetary and financial stability. Consistent with its remits, the MPC will address the consequences of that decision for growth and inflation over the monetary policy horizon. There are limits, however, to what monetary policy can deliver. When shocks drive demand below supply, monetary policy can soften the blow. On the other hand, when shocks drive supply below demand, monetary policy can make the unsustainable sustainable. Over the medium term, monetary policy can deliver a level of demand consistent with the path of the economy's supply in order to meet the inflation target. But monetary policy cannot immediately offset all the effects of a shock. Moreover, neither is the path of supply nor the path in the medium term of economic growth and its implications for jobs, wages, and wealth the gift of monetary policymakers. These will all be driven by much bigger decisions. Whatever the outcome of the referendum, the Bank of England's best contribution to promote the good of the people of the United Kingdom will be to use all of its tools to support financial stability and to chart the right path for inflation back to target. And with that, Manoush, Ben and I would pleased to answer your questions.
And as always, could you please say who you are, which organisation you represent, and keep to one question only for the first round, please. Kamal first and then Chris.
Thank you, Jenny. Kamal Ahmed from the BBC. Your gloomy forecast today comes after a whole host of poor economic data for the UK on manufacturing, on construction. Some people predict that the April growth figure could already be as low as 0.1%. You have said that if Britain votes to leave the European Union, that could lead to materially lower economic growth in the UK. Given the gloominess of your forecast and the data, can you rule out Britain's economy being tipped into recession if we were to leave the European Union?
Okay, well, let me distinguish. We published one forecast today, which, as per our convention, is based on government policy being followed. We always do that, and we have done it today. And that forecast is affected in the short term by uncertainty associated with the referendum. I think we all know that, and we see it in a variety of indicators. And we believe that this uncertainty is influencing the slowdown, is one of the influences for the slowdown in the first quarter and a more marked slowdown, more marked deceleration this quarter. But conditioned on that assumption of remaining, those uncertainty effects dissipate in subsequent months. And the actual forecast we have under Remain, I wouldn't describe as gloomy. There are these uncertainty effects. They dissipate by the middle of next year. Ultimate effects on the economy dissipate by the middle of next year. And we have growth around trend over the course of the year following the referendum, and then picking up a bit, and actually puts the economy in a bit of a position of excess demand, which is why inflation is above target. So, yes, short-term effects, but in the fullness of time, move out of the way. Now, we have a responsibility when we have a major risk to the forecast to talk about those risks to the forecast, if those risks could manifest over the monetary policy horizon. And quite frankly, if it is an issue that the MPC has discussed, has analyzed, has looked at. As we've indicated, you see it in the minutes, you see it in our monetary policy statement, the biggest risk to the forecasts concern the referendum, not just about the sort of fog of uncertainty around the data in the near term, that level of uncertainty, but the fact, or the judgment that if there were a vote to leave, that would have material consequences for both growth and inflation, and therefore affect the stance of monetary policy. I would stress that that effect on the stance of monetary policy is not automatic, because there's potentially big effects on each of the exchange rate, the supply of the economy, and aggregate demand. And it's the sum of all of those effects which would the MPC would have to consider in setting the stance of policy. In that scenario, as we've said, that we would expect material slowing in growth, a notable rise in inflation, a challenging trade-off. And I think that is what I would take as the important point here, which is that we're providing information as best we can about our potential reaction function in that scenario, the key drivers of where policy would go in that most important risk scenario.
Just to push you, just to ask.
Say one question only. You can come back to it.
Materially lower growth, does that mean negative and possible recession? That's all people want to know, isn't it?
I'll see if anyone else asks the question, and then we'll.
Chris.
Yeah.
Chris Giles from the I think the question really is there going to be a recession? So I'll ask that question straight up. I mean, you've given quite a detailed forecast of the Remain side.
Yeah.
The public want to know from a reasonably independent source, or a very independent and credible source, which the Bank of England is, what is likely to happen if they make choices. You've given quite an indication in the report what you think is likely to happen in words, but not in numbers.
Right.
You've said unemployment is likely to rise given our productivity. That suggests a recession. Will you use the R word?
Okay. All right. Recap on focusing specifically on Remain, because, Kamal, I did want to make clear about the central forecast that we have, which is conditioned on remaining. And Chris is focused just on the leave risk scenario, so I'll answer that. Material slowdown in growth, notable increase in inflation, that's the MPC's judgment. It's a judgment not based on it is a judgment not based on a whim. It's a judgment based on rigorous analysis and careful consideration. And it is the judgment of the independent MPC, and it's the judgment of all members of the MPC. I'll make that very clear. Now, of course, there's a range of possible scenarios around those directions, which could possibly include a technical recession, could possibly include that. We haven't done a formal forecast. The thing that I would stress, again, what's important here from our perspective is to provide information, provide perspective, not just about the major risks to our central forecast, but what it might mean for monetary policy and what are the considerations for the stance of monetary policy. Because what we don't want to do, wouldn't want to do, which wouldn't be fair to the British people or would be to pop up at the start of July and say, oh, by the way, this is what we think, this is what we thought then about the situation now. So this is our best perspective. I would stress, though, that our perspectives, both in terms of the central forecast, conditioned on Remain, and our perspectives around risks, extend out to the monetary policy horizon. It's entirely within our remit. Our remit is 2 to 3 years. We're not making a judgment. We're not making a forecast. I know you know this, but it's important to stress it. We're not making a judgment or a forecast or an assessment of the longer-term economic consequences of either decision, nor will we make that determination. But we have a responsibility under our remit. It is explicitly in statute and in our remit to talk about the risks and the trade-offs that monetary policy faces so that the British people can better understand the potential paths of monetary policy, because if the one thing we all know is that the path of the economy, the shocks that can hit an economy are uncertain, and it's better if people can anticipate how the bank, specifically the MPC, would respond if those uncertainties come to pass.
Phil, and then Faisal.
Phil Aldrich at The Times. You talk about the potential path of monetary policy in response to what could be a technical recession. The Monetary Policy Committee did discuss Brexit. At that discussion, what was the sort of range of policy responses that were considered? Was there a rate cut considered, and what would it mean for gradual and limited in terms of rate rises if you chose inflation as the bigger concern?
I understand the question. Just to be clear, we discussed the economics of that scenario, of that risk scenario, to have a richer appreciation of that. So we had a rigorous discussion around that, fulsome discussion around that, supported by analysis. We didn't develop a full projection, though, to be absolutely clear. But we had that discussion. We didn't then translate that into the stance of monetary policy, because the only decision we were making is about the circumstances here and now. What's the appropriate stance of monetary policy as we are today, given our central forecast? And it was clear to all members of the committee, as you saw with the announcement today, 9-0 vote, that the most appropriate stance was to maintain policy as it is, bank rate at 0.5% and purchased assets at 375 billion sterling.
Faisal Islam, Sky News. Governor, you've gone further than you went in the Scottish referendum. You've gone further than you have so far on the EU referendum. Is there not a risk that this institution, centuries old, that people look up to for independent views on the economy, may be being embroiled in deeply controversial politics?
I would flip it 180 degrees. This is the biggest risk in the judgment of the Independent Financial Policy Committee, 10 members. It's the biggest risk in the judgment of the Independent Monetary Policy Committee, 9 members, to their remits, to the achievement of their remits. It is our responsibility to analyze those risks, to consider how and if we should mitigate those risks, and then under the standards of transparency in this country, which are appropriately extremely high and are consistent with the enormous responsibilities this institution has, we have to communicate those. It's the political choice is to suppress this type of analysis, these types of discussions, so people can understand. But this is entirely within remit. So let's take a different circumstance. You referenced Scotland. The issues around Scotland were issues that principally affected financial stability in the short term. Issues around stability of certain financial institutions headquartered in Scotland. They were not issues that potentially, and these were serious issues we took seriously. We had contingency plans. We revealed them after the fact. But they were not issues that at the time, in the judgment of the MPC, and we were on the MPC at the time, that rose to the level of being the biggest risk to the economic outlook for the UK and for the potential stance of monetary policy. It's just a different situation. In terms of why are we talking about this today? We're talking about it today because we have a responsibility to produce an inflation forecast, and when we produce that, it's not just a point projection, but it gives a sense of the major risks. And what comes with that is responsibilities of transparency, nothing more.
Larry and then Scott.
Larry Elliott of The Guardian. You mentioned in the report and in your letter to the Chancellor that sterling could fall perhaps sharply in the event of a Brexit vote. What do you mean by sharply? It's already fallen by 9%. Do you mean more than 9%, by 20%? Not very specific. And just adding on from that, do you think that fall would be permanent, or do you think sterling would bounce back?
Okay. Let me start and then ask Ben to amplify. It's relatively unusual that we would talk about the currency and the direction of the currency. It's happened in the past. It happened in the aftermath of the crisis, understandably, because there was a major supply shock that had happened to the economy at the time, and it made sense to give the context. The circumstances at present are that movements in the currency appear, some of the movements, a proportion of the movements in the currency have an identifiable cause. And we were able to do some work in order to estimate that. And then in addition, the stance in markets, both the fact of the way the currency moved with specific events, the tenor of options markets, the skews in options markets, and the potential shift in fundamentals all point in one direction for the currency. Now, it's a question of dimension, which I wouldn't want to give, but Ben, you might want to.
Yeah, as the Governor says, we haven't made any numerical forecasts in the event of a leave vote at all. That would include the currency. What is true is that the behaviour of the foreign exchange market over the last 6 months suggests that the probability of leaving has had a dampening effect on the exchange rate. And there are a range of things that might affect it in that event, some of them more enduring than others. I think the Governor referred to the main categories in his opening statement. If there were any enduring effect on productivity, particularly in tradables, that would have an enduring effect on the real exchange rate. Similarly, if there were restrictions on the degree of openness or a less open economy, perhaps including even changes in tariffs, that would have a permanent effect, or at least a more enduring one. And in the short run, if risk premium on sterling assets were to rise, you might expect the exchange rate to overshoot slightly. That effect would dissipate over time. So the range of potential factors, we've not put numbers on anything. It would be particularly difficult in the case of the exchange rate to say anything precise about the numbers at all. If you look at the average move in sterling between inflation reports, it might be the order of 3 percentage points, one direction or the other. I imagine we'd be talking about larger numbers than that, but we're not going to put numbers.
Hello. Scott Hamilton, Bloomberg News. You've talked today about this challenging trade-off that the MPC will face between stabilising prices and the hit to output and employment. Could you elaborate on the potential policy tools that the Bank of England has that could respond with, and how the MPC sees their associated trade-offs? I mean, might the MPC favour responding initially with liquidity and credit easing measures rather than loosening of monetary policy to avoid exacerbating this drop in the pound?
Yeah. Well, the first thing I'd say is it depends which way the trade-off falls, because both your examples went in one direction, and that's the point. It's not an automatic response. The direction will depend on the balance of these forces. That's the big message I would take from this at this stage. The second point, which follows from the first, is that in either direction we're in conventional monetary policy space. Obviously, if we needed to tighten policy, a conventional instrument. If we needed to loosen policies, the judgment of the MPC that we have room to further lower bank rate before we would have to use more unconventional measures. And then the last thing I'll just reemphasize is that we have a range of options on the so-called unconventional side, from quantitative easing to credit easing, that would be available. If people are interested, and I'm going to end my answer here, but if people are interested on the sort of liquidity and other side, I think it would be useful to have Manoush talk about some of those issues if there's an interest. I'll wait for the questions.
Ben Chew from The Independent. Governor, the Chancellor has put out a statement this morning saying that the bank's views on this suggest that Brexit would create a lose-lose situation for Britain. Either way, we'd be poorer. Now, there's not many wavering voters who would listen to that and think Brexit was a good idea. So the question is, has he accurately characterised the bank's views on this, or is he putting undue words in your mouth?
Well, the Chancellor is responsible for his words. Our analysis only relates to the stance of monetary policy. Ultimately, our remit is to deliver low, stable, predictable inflation, and to do so in a fashion that avoids undue volatility in employment and in output. So judgments about the longer-term economic implications, or other issues related to this vote are for others to make. We're only focused on an important issue, monetary stability, as the MPC, but an issue that's relevant over the course of the next 2 to 3 years.
And Jason, and then Jeff.
Hi, Jason Douglas from the Wall Street Journal. Can I ask you, please, about another risk you mentioned in the inflation report, in the account of the discussions between the MPC and the FBC? You describe how a vote in favour of Brexit could lead to major financing difficulty. You're presumably referring here to the current account deficit. What's the MPC's assessment of the risk of a sort of sudden stop that a lot of people seem to be worried about, and how would policy respond to those sort of issues, please? Thank you.
Well, so now speaking from the perspective of the FBC, because you've asked it, the judgment is that the reason why the FPC judges that risks around the referendum are the biggest domestic risk is because of the potential to amplify pre-existing risks, one of which is what you're asking about, the current account. And the issue is, broad brush, is that the structure, the current account, as you know, is very large by historical and international standards. Now, if we're going to have a very large current account deficit, this is the one type you want to have. Our liabilities are in sterling, and it's not accompanied by rapid private sector borrowing. But it is financed, a substantial proportion of the financing is through foreign direct investment, and it would appear that one of the considerations behind that foreign direct investment is, or for some of it at least, is the UK's status vis-à-vis the rest of Europe. So replacing, at least for a period of time, that FDI is likely, all things being equal, likely to result, if not a sudden stop, I wouldn't necessarily go there, but in higher risk premia on a range of sterling assets, higher financing costs. The consequence of that is less of it will come in. People will make decisions around that. But in terms of market functioning, because you referenced market functioning, I just wonder, Manoush, can I ask you just to say a word on this is not news, but I think it's important to understand that what we're doing as the bank as a whole is to use everything we can to mitigate any of these factors in and around the referendum, regardless of outcome. Our job is to try to mitigate, and maybe just say a word if you could.
Sure. I mean, on the sterling side, as you probably know, we've already announced that we'll be doing 3 additional auctions in June, 2 before the referendum and 1 after, to make sure that sterling liquidity is available. And we also have a very well-developed framework in the sterling monetary framework to provide liquidity to firms that need it. On the foreign currency side, clearly the first line of defense is firms' own management of their resources, and in the course of normal supervision, the Prudential Regulatory Authority has made sure that firms are well prepared and have plans in place around the referendum. In addition to that, many UK banks, the larger ones, have access to foreign currency through other central banks, through the ECB, through the Fed, through the Swiss National Bank. And we ourselves, of course, have the swap lines with the G7 as well as the Swiss Central Bank to provide foreign currency should we need it.
Jeff, and then Hugo, please.
Governor, you focused a lot in this report about the potential domestic impact of a Brexit vote. But could I ask you for the international context? Because in the report you talk about some improvement in the international context. China, no hard landing perhaps, the commodity market starting to turn a little higher, America doing okay. But in this debate, we have seen President Obama arrive and threaten to push the UK to the back of the queue over a trade deal. And we've heard noises from Brussels that perhaps there would be financial consequences, i.e. a levy placed on the UK should it exit, in the same way that some other states have partnership arrangements for trade which they pay for. Can I ask you, did you discuss what perhaps some of the implications of those threats might be on the economy as a result of the external international pressures rather than the domestic ones? And if you did have those conversations, what kind of conclusions were drawn?
Okay. I think the first thing to say, just to overall context, is that if we had sort of detailed discussions about such issues, we would talk. It would show up in the minutes. And that's the first thing. The second is to reemphasize that our forecast, which, as you know, is conditioned on Remain, government policy, standard convention of the bank, always followed. The risk scenario, but our forecast has a 3-year horizon. And these types of issues start to become relevant upon exit. Now, the question is how much of anticipation of these changes, however they pan out, whatever negotiations done, how much anticipation of those changes and uncertainty around that starts to affect the path, not just of demand, but actually of supply in the economy. Think less investment affecting productivity as a consequence of that. And that's part of what plays into this risk scenario and the difficult trade-offs. On the international dimension, I would say 2 points on the international dimension. I talked less about the structural aspect of the international dimension. But just observe that, as we do in the report and the minutes, there is a possibility of a negative spillover to global financial conditions because of uncertainty generated in this country. That is a possibility. That shouldn't be a surprise to anybody in this room. This issue is the #1 issue that is raised with me and my colleagues every single time we meet a fellow central bank governor, foreign finance minister, head of a major corporation internationally, head of a bank, head of an asset manager, and I would say most domestic, small and medium-sized enterprises that we meet. So it is an area of focus, and it is a reasonable assumption that the uncertainty around this can have spillovers internationally for a period of time. Now, we would expect that in the event of, as in our core forecast, this doesn't have an impact because uncertainty dissipates and the result is the result. And our forecast is, for the global economy, is the components have changed a bit. You alluded to some of it in your question. But it's pretty much the same forecast as we had in February. And I would characterize it, I think, fairly as downside risks internationally in the short term have gone down, but they are unchanged over the forecast horizon. There's still downside risks to that global forecast. Right.
Thank you. Governor, I think at the end of your opening statement, you said that monetary policy would not be able to immediately offset the impact of a shock following Brexit. Should the economy head towards recession in the event of a vote to leave, are you saying that the bank would effectively be powerless to prevent it from happening?
Well, look, that statement, that's a general statement, and there are certain shocks. Monetary policy operates with a lag, long and variable lag, as you know, and if there is a sharp adjustment in demand, in activity, from whatever event, it will take some time for stimulus, if it's provided, if it's appropriate to be provided, for it to course through the economy and offset, to cushion that fall in demand. At this stage, I'd loop back to the judgment at this stage of the committee in discussing the risk scenario is that there's multiple effects, potential effects on demand, supply, and the exchange rate. And from our sole focus, our primary focus, I should say, of bringing inflation back sustainably to target over a 2 to 3 year horizon, over the monetary policy horizon, the direction of monetary policy is not automatic.
Hi, Halia Ibrahimi, Channel 4 News. You said earlier that your report is based on rigorous analysis and careful consideration, but a lot of Brexit campaigners would just say this is more project fear, not just because the Chancellor was able to conclude the bank would be forced into a lose-lose policy decision-making situation, but also because there's very little detail about any potential upside to the boost in trade caused by the pound, any slacking off of regulation, etc. What has the bank done to ensure that you don't get caught out politically by people who think you might be just on the side of the Chancellor?
Well, look, first off, I mean, the Chancellor answers for himself in his words, so I'm not, I haven't even seen the comments that you're referencing. We're fully aware of the return to exports and the impact on net exports of a persistent move in the exchange rate. But also, I think we might be have a little better appreciation of the potential inflationary consequences of an exchange rate move, particularly if that exchange rate move is associated with a supply shock, a negative supply shock. And I'd refer back to, was it the February report where we went through this, and and again, we summarize extensive analysis in reports, but we've done a lot of work as a committee and as an institution on exchange rate pass-through that has learned from the experience of the post-crisis period. The fact is that, and look, in 8 years, you're going to get all this under the Bank of England, which is all the transcripts of the discussions, and all the relevant analysis is going to come up. And I'm hoping to still be alive in 8 years, so you can come and say, did you just say it? But these are risks. This is the independent MPC looking dispassionately at issues in fulfillment of its remit. And I think what's important about this is that this is a possibility, and that in the event that it's the decision of the British people to leave, that there is an understanding of what the economic issues that face the Bank of England, the stance of monetary policy, and what it might mean. And it is far better to outline those in advance than, as I say, to pop up and to address them in real time. And apart from anything else, we have a responsibility if we have done analysis, if it has been top of mind, if it has been a preoccupation of the MPC, if it is, in its judgment, which it is, the biggest risk to the forecast, to talk about it. And that's what we've done.
David, and then Harry.
David Smith, Sunday Times. Governor, you've said that the monetary policy response to a leave vote could go either way. It's possible that interest rates in the economy would go up even if monetary policy was relaxed because of a rise in bank funding costs. Do you think the kind of thing you've talked about today on liquidity and so on, you could prevent that from happening, or is that something that would just be part of the new era? And so interest rates as experienced by ordinary people and businesses would actually be higher in either event?
Yeah. Well, you're absolutely right. It's possible that bank funding costs and a broader range of corporate borrowing spreads, whether in capital markets or through banks, could increase for a period of time because of uncertainty, not least, but also because of financial flows. The judgment we would take into account as the MPC would be how long is that likely to persist, and how, as you know, how does that blend with the overall stance of demand, prospects for supply, exchange rate, et cetera, and do we need to adjust overall financial conditions by changing bank rate? Your question on liquidity, though, is apt, because one of the things we can do and would do, and as Manoush has talked about a bit earlier, is ensure that the one thing that doesn't happen is that there's a temporary dislocation in markets, or there's a shortage of liquidity for banks that have lots of collateral, but there's timing issues or other factors that mean that bank funding costs go up unnecessarily. And so the types of facilities that Manoush's we pre-announced and Manoush's has highlighted. I mean, these can flex up very rapidly. It's standard collateral that's pre-positioned with the Bank of England already. It's readily accessible. In our view, actually, that when we, at some point in the distant future, we get out of this extraordinary time where rates are as low as they've ever been and liquidity is otherwise fairly ample in the system, our view is that these types of facilities will become, their use of them will become much more frequent because there will be temporary dislocations in markets because we push liquidity risk into markets. And so the short answer now to your question on the liquidity side is that that's one of the things that we're looking to mitigate in either scenario if there's any stress, so that these costs aren't unnecessarily passed on to households and businesses, yes.
Good afternoon, Governor. Harry Daniels from LiveSquawk. As you've stated, as the statements said, forecasting visibility is poor at the moment due to the ongoing uncertainty around the Brexit vote. How soon after the vote, either way, would the MPC judge to be appropriate to then resume normal, viewing
normal
of the
business? Yeah.
And when would things start to crystallise and we look at this rate rise, that the path which you stated that we're still on? How soon after the actual vote would you deem appropriate?
Okay, well, I'll try and give you the headline, and I'm going to ask Ben to expand, which is that we have done, our forecast incorporates some significant uncertainty effects. And then we have to make a judgment about how quickly those effects tail off. And there's a lot of experience with these type of circumstances. There's, I think, the case history and some of the econometrics goes 30 different examples globally. And so there's a normal time decay to that uncertainty coming off. There's reason to think that uncertainty would come off more rapidly in this circumstance. But then it's a question of how rapidly and what the effects are. And,
no, I don't have much. There's a box that describes some work we've done on this, page 14, I think. And there are two distinct points to make about the timing. One, as the Governor just said, is that relative to the sort of average duration of these uncertainty shocks, the committee's made a judgment that that would come away slightly faster than normal because we can see an exact date, conditional on Remain, when that would go away. On the other hand, the effect of a given shock seems to be quite protracted on the economy. So it fades away, but actually the forecast is affected to a diminishing extent, but still affected by this shock, even in the event of a Remain vote, actually into next year. Now, of course, there's always uncertainty. A committee always has to face sort of signal plus noise and faces the job of trying to extract one from the other. But there is that little bit more, and the effects on the economy will weigh a little bit longer. So probably the answer to your question is not absolutely straight away, a little bit beyond that.
Sue? And then Richard. No?
Hi, Sue Chan from The Telegraph. A question on Brexit incomes and unemployment. You talk about the obvious connection between Brexit eroding people's real incomes. Could you talk a little bit about other forces that might affect that? Some economists say that in the long run, because the UK economy, at least now, it has a very flexible labour market, the adjustment will be less in unemployment and more in people's wages being reduced. And just a clarification, you talk about materially lower growth, a notably higher path of inflation and perhaps rising unemployment. Is the word stagflation too strong?
Well, in terms of long run, one of the great strengths of this economy is the flexibility of the labour market and the flexibility of the economy as a whole. And it has had many shocks in the past and will in the future, and adjust well to them. We don't have, as you know, and are not going to make a longer-term assessment of a stay or leave, comparison of stay or leave scenarios. So, in that regard, I can't give you more than an impressionistic answer to that question, and so I'll skip it. In terms of materially lower, higher, I'd refer back to my answer to Chris Giles, if I may, which is that broad brush, that's the direction we see. There are scenarios around that. And the flexibility of the economy will help. The ability to, what's the best contribution of the bank, the MPC specifically in those circumstances, regardless of which scenario, it's to be clear about the trade-off, about the horizon over which we're going to bring inflation back to target from likely above, quite possibly above, and to only do just as much as is necessary in order to do that, no more. And that's why it's important not to pre-wire policy, if you will, in those circumstances, because we don't know the absolute magnitude of what these shocks would be in that scenario. And we would have to see them and see the persistence in order to judge the right range of policy. We do have a judgment, and it's the judgment of the independent MPC, all 9 members of the MPC, that growth would be materially lower and inflation would be notably higher. And that is a considered judgment.
Mario Błaszczak, World Business Press Online. Governor, some of the commercial surveys indicated that there is a certain extent of cost side pressure at producer prices. So what if producers raise prices? To what extent do you reflect that in the black box of forecasting inflation short term?
You're in charge of the black box, aren't you?
Oh, right, yes, of course. I'll give you the standard answer, which is one of many, many things that affect the forecast. To the extent it affects it at all, those little pricing surveys, it's really much more in the short run. I think that they can be informative about that. Further out, which is probably more relevant for monetary policy, looking at inflation 18 months to 3 years ahead, I don't think they're of great relevance, and there we rely on our economic model. But certainly it can matter for the near-term picture.
In terms of the concrete measures the bank will be taking to support the economy around the referendum, I mean, you've touched on the extra auctions and so on. Can we expect to see any more concrete information ahead of the referendum, or is this essentially it in terms of what we will be hearing? And is it a concern that, obviously, the number of MPC meetings is actually going down from later on this year? Given the rising risks to the British economy, is this a concern that the MPC will actually be meeting less regularly? Thank you.
Yeah, thank you. In terms of measures, look, I mean, never say never, but one of the lessons we learned from the Scottish experience was that it was better to announce potential liquidity facilities earlier to avoid sending a signal. So when we, you get a few weeks in advance of an event, a known event, and you announce a liquidity facility, however harmless and prudent and careful that is, some people will interpret it as a signal of potential stress. So by announcing it months in advance, these series of auctions that Manoush talked about, we think we've avoided that, and I think we have. We have the mechanisms in place, and we have the benefit of. So broadly, my answer is yes. I wouldn't anticipate anything else. We have the benefit of having within the broader Bank of England the supervisory arm, the PRA, and the supervisors doing their job, which is to go out and ask firms about their contingency plans. So we're not directing them what to do, but we're asking them what they are doing. And then the PRA board and the FPC are informed about those, what banks specifically are doing to mitigate any risks that they potentially see, and that's the system working as it should. And the MPC's informed about that as needs be.
Hi, Dan Hinge from Central Banking. You mentioned that some of the indicators are getting harder to interpret. Are you having to apply more judgments to your models? What's the kind of relationship between what your models are telling you and how you're adjusting those with your own conditioning assumptions? And is that increasing kind of the risk that you might be wrong about the forecast?
Well, I think the first thing is to say that we have to make a judgment, as I think Ben referred to, and it's certainly described in the report, but to make a judgment that there's this big increase in uncertainty, Bloomian uncertainty, these various measures. Some of that arguably is beginning to show up or has already showed up in some of the SIPs, the PMIs, or some of the confidence indicators, some other hard economic data. So we have to make a judgment about how not to double count that. So yes, that means that for a period we are adjusting the relationship between, I mean, we still check the pure relationship, if you will, or the historic relationship between a given survey or other indicator and what it could be telling us about investment or consumption or growth as a whole. But we're overlaying the uncertainty factors and making judgments around it. It just means that in real time, yes, things are a little less informative, and there's two-way. I think the important thing, there's two-way risk around that. We could be overestimating the effects of uncertainty, and the underlying economy therefore could be slowing of its own accord more than we think, or we could be overplaying it a bit, and the opposite is going to happen. And so, the question goes back to Harry's question, I think, which is that when we get out from the other side of June 23rd and into subsequent meetings, then we make a decision. I'm sorry, I didn't answer one of the questions there, which was about frequency of meetings. And just to be clear on that, we will be meeting every 6 weeks as opposed to every 4 weeks. So, let's be realistic in terms of the gaps in time. And then secondly, we can meet anytime. We can meet tomorrow if we wanted to. And make a decision. We can meet this afternoon, actually, if we wanted to. We can meet right now. We come in here, and you guys can watch. And at some point, that's where central bank transparency will end up. And then after a few of those meetings, no one will show up again to watch this stuff.
Hi, Jamie Robertson, BBC. You mentioned about trading relationships and about, in a post-Brexit world, that trading arrangements with other countries would take some time to renegotiate. Can you expand on that at all? And how serious a risk or how much of a problem would that prove to be if it was a prolonged period of time?
Well, two things. I think it's commonly acknowledged that it's an uncertain period of time to renegotiate these agreements, and there is some uncertainty about if it were a vote to leave, what the relationship, particularly with the European Union, would be, both for trade and investment. And for the monetary policy horizon, what's relevant are two things. For most of it, for the next 2 years, assuming a negotiation begins quickly, for the next 2 years, what's relevant is the uncertainty around what the actual agreements are. And do businesses invest and do people spend on the basis of certain assumptions, or do they wait? Experience, common sense tells you that people wait a bit. But econometrically, you can see that people wait and businesses wait to a degree in anticipation of clarity. And that's one of the reasons why growth would be expected to slow. Once the arrangements are in place, yes, it matters. It matters for, at least for a period of time, because it means that the economy has to adjust to those new relationships unless they're exactly the same as they were before. There will be some capital that is stranded. There will be some jobs and capital that needs to be reallocated to different sectors. It will have some impact for some period of time on the productive potential of the economy. But that's for the purposes that we care about as the Monetary Policy Committee. You only see the first bits of that in year 3, if you will, of our forecast, and then our forecast stops. So we don't make a judgment, and we're not going to make a judgment or a forecast of that longer-term scenario, the equilibrium, if you will, once everything's in place in a post-Brexit world. That's for others. Many others are doing analyses of that, and they can debate it out. The reason we make a forecast, just to be absolutely clear, is we need one in order to conduct monetary policy. We reveal it in order to explain it, and we talk and reveal about the major risks in order for people to understand that, you know, a forecast isn't a guarantee, and how we would react if certain major events were to transpire.
We're almost out of time. Is there anyone who hasn't had a question yet who would like to ask one? Ooh. It's not the response I was expecting. In that case, chance for one more. Faisal, you've put your hand up.
I just want to clarify one thing. You told me that the biggest risk for both the MPC and FPC was now Brexit, but at the Treasury Select Committee you said it was the biggest domestic risk. That's just a point of clarity. And in general, at the TSC, you warned about the impact specifically of leaving the single market. That is now the established policy position of the head of Vote Leave. Has that raised further concerns for you about risks, particularly to the financial sector?
Judgment of the FPC. I thought I said domestic risk for FPC. Biggest risk to the forecast for the MPC, why we're here today. Risks concerning the referendum, which include the sort of fog of uncertainty around current data and forecasting under Remain, and the issues that we've been discussing in some of these questions. From the FPC's perspective, judgment of its most recent meeting and report is that the biggest domestic risk, put risks around China over the medium term as higher. In terms of the implications of a WTO-type relationship, if you will, for the financial sector, from a financial stability perspective, it's not clear to me that that changes the severity of the risk to financial stability. It would arguably, I think quite realistically, have implications for the level of activity in financial services in this country, but that is a different issue, and I'll leave it at that.
Okay, we've run out of time. Thank you very much, everyone.